Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update today. And just wanted to give you a couple of these this week because of the election, and everybody was waiting on the election. And we had a Fed meeting this week, so there was a lot going on. I wanted to make sure we got a couple of these out to you this week, and kind of put things into where we're at, where we're headed. So. I'm going to jump right in here with some stats and some notes that I've been taking over through the whole week for you guys. But we're seeing, pricing pressure for sellers right now is tough because, we've got a surge in inventory. We had an increase in inventory since the beginning of the year, about 37%. Which is positive for buyers. Okay. Long story short, it gives them a little bit more options, a little bit more negotiating power. That's just the way that works, supply and demand sort of thing. Um, Even though overall we don't have enough supply or demand, that's just kind of where we're at. So contract ratios, which tell us kind of the now. I'm going to share my screen with you and show you what this looks like. So the contract ratios from the Cromford report show us that right now our status is looking a little weak on the contract. So if we're up at say 60, that's kind of more of a hotter market on this index. This kind of shows you a little bit more of. Let me show you the map here. What it looks like on a map right now. These areas where you see the yellow, like here in El Mirage, or over here in Chandler, in that zip code of 85224. For actives to under contracts kind of tell us right now what the hotter or colder areas are of the market. So when we look at this, hot is going to be 60 to 80, balance is going to be 30 to 60. That's kind of balanced to warm. For these different colors, we're looking at cold is about 20 to 30 on the contract ratio chart, just to give you an idea. Um, of course, when we were in a crazy market, a lot of stuff was between that, 60 to 100 marker back in the crazy market a couple of years ago. But anyway, you can see right now things kind of now a lot of this is just, yeah, there's more inventory in the market. Usually, we don't end the year with more inventory than we had in earlier years, so we'll see what happens there as far as people taking their homes off the market for the holidays and what goes under contract for real and all that. I think we're seeing also, rates coming down, which we'll get into here in a second this week, and we'll talk about, what now that we're through the election, what that kind of looks like a little bit more. But we are seeing kind of this weakness in the market. So, right now in our area, but again, a lot of this is seasonal. A lot of this is very seasonal as far as, sellers have a little bit less leverage, buyers have a little bit more leverage at the end of the year. It's just kind of the way it works. There's a little less inventory, but there's a little less buyers, all that kind of both sides, supply and demand, buyer, seller, tug of war there. But loss in purchasing power since the rates went up to about 7% earlier, we saw that home buyers, if this article pops up for me here, let's see, there we go. Home buyers lose $33,000 in purchasing power in 6 weeks as mortgage rates hit 7%. Okay, so that's a thing. Obviously, a buyer, with a $3,000 monthly budget can now afford a $442,000 house, which is kind of our median average here in the valley, in the greater Phoenix area. And that's down from 475 just a few weeks ago due to the higher rates because we had those lower rates that were closer to that six mark. So it's a big difference. Again, for about 100 basis points or 1% difference, about 5 million more buyers can potentially enter the market across the country. So in any case, um, mortgage rates today are down, which is great. We're going to see better pricing, and that sort of thing. So That's all good. Now, the stock market has had a surge this week. The Wall Street heads for the best week of the year after the Trump victory. I'm really going to say this, no surprise there, because he's a businessman. He's been talking about a lot of things. Now, some things he's been talking about have gotten people in a little bit of a tightwad. But I'm going to tell you right now, some of the things I mentioned earlier in the week, I'm going to reiterate and kind of drive home for you to understand a little bit better. By the way, here's our supply right now. Before I get into that, 22,000 right out of the MLS. Oh, wait, actually, let me update that. Okay. Just the actives, all property types, there's 21,000. Okay. A little less than earlier in the week, 21,784. So, this right now puts us in a balanced market. I'll get more into that in a minute, where we've got somewhere a little over a 4 month supply, which I already went over with you earlier in the week. So stock market surge, but Chris, stock market gets up, economy gets better. Um, GDP goes up and unemployment stays low. Isn't that bad for mortgage rates? Well, it can be, but in trade wars, isn't that going to drive prices up? Well, here's the thing. Again, some things to keep in mind. Again, some markers for what he's planning on doing. So if you take out, if you talk to a business person, and you ask them, like what is even more important than tax reductions for businesses, and not just big corporations, but small businesses, right? Which is part of what he's his overall plan is, and to get rid of things like taxes for tips. Again, these are just the plans and all the data points, whether you like them or not, just going by what the policies are going to be and how that's going to affect things. Okay. Let's take, any of the emotions out of it for a minute. Let's look at what this really means for real, because numbers are numbers, data is data. So, if you lower the cost, and the red tape to run a business, to start a business, to start projects, okay, this means that now, businesses can move forward. Just the mere fact that you pivot to the idea that we're going to drill baby drill, or that we're going to frack baby frack, whether you're environmentalist or not, doesn't matter when it comes to the point of how we do energy right now. Is it going to cost more or less for energy? Okay. And is that going to equate in less cost for goods for us? Whether they're being imported or made here. Okay, if they're made here, it's going to cost less to heat and cool the building that the things are being made in, to run the machinery, to make the things, to run the services that are being run in that business or company, to make that product, to make those molds, to run things. It costs less money. If it costs less money to run things with energy, that's kind of a baseline, along with the other regulations that government imposes on businesses. Okay. And those costs for energy regulation and taxes for big corporations and small businesses. Like, I'm a small business owner. Those things have to be, in order to make a profit, have to be passed on to the consumer. Okay. Or are going to be passed on to the consumer. So, in effect, if it costs less to do those things, now I can hire more people. That's good for jobs, yes. But Chris, isn't that bad for interest rates? We'll get to that in a minute. But then, the whole idea of the cost, right? So number one, if we have more middle income jobs here, manufacturing jobs, through these tariffs that are going to be used strategically. It's not like, okay, automatically everything's going to be tariffed 100 or 200%. Not how it works. It's strategic in order to get certain geopolitical policies done, in order to, then bring about manufacturing here, in order to bring maybe even strategically for, for our own security, as far as militarily and all those sorts of things are concerned. But if you're not only energy savings, energy independent, you're not getting your stuff from Venezuela. Now you're creating more of a GDP also in your own country. Okay. Which is good for the economy. And if your energy now also to a point where your energy export, and again, just pivoting those ways, doing things like pipelines, doing things like, drill baby drill, all those things just signal to the markets, oh, now we can lower prices. That's just kind of how it works. It doesn't happen, you know, you don't have to wait for the effect of the actual drilling and the refinery and all that to those points. It's moving in that direction automatically moves the markets, okay, in a positive way for the economy, okay, to begin with. It's just like when the Fed signals we're going into a rate reduction cycle now, maybe into a more accelerated eventually. By the way, Jerome Powell this week said he's not stepping down. Well, if he can be appointed, you can be removed and replaced. Just saying. I guess he thinks he's the Wolf of Wall Street. I'm not leaving. Okay. Well, okay. We'll just wait and see what happens there. But, a lot of people like me and a lot of people, in different places. I like to listen to Housing Wire, Barry Habib, Logan Motoshami. A lot of people I like to listen to because they're right on these factors. The Fed has been way behind, always is behind the bond market. Was behind on, you know, taming inflation to begin with. Now they're behind on going the other way, and it's really going to hurt. It's really hurting the housing sector, and they're behind the eight ball. You have to kind of be in the now and ahead of these things so that we don't end up in recessions and stuff. So that the slow and old model, the 1980s model, the 1970s model, they want their policy back, because our economy is totally different now. And this idea of what is the inflation, even maybe the inflation targeting and all that, because you also don't want deflation, right? But you want kind of a steady thing. Now we know under the past Trump policies, where were we? Well, our inflation rate was under 2%, which was great, but we had low interest rates. Now, how does that happen? Well, you put the other things in place first, to, lower the tax structures for everyone. Okay. And, you improve the economy, but you lower those taxes and then, use tariffs strategically where needed or threaten tariffs where needed, bring about that great economy, but you have this energy underpinning of it doesn't cost as much to move things, to make things, to run a company with energy. Okay. Now, and less regulations. That's the energy regulation. Those are two of the big, even before the taxes, those regulations, if you ask a business owner, are huge. Okay. Just the fact that it costs me double or triple now just to go show a home with gas, okay? Just stuff, just in my own small business, just those things, okay? Just if you're not used to owning a business, just put yourself in a position of a business owner. If you're having to make a product or do a service, so when you take all that and you don't have to pass those things on to the consumer and you have more middle income, upper middle income manufacturing jobs or service jobs now being brought back in. All these different factors and data points are there, and then you have the Fed doing what the Fed should be doing in a timely manner, um, or restructuring how that even works, maybe. Um, well, I'm not going to get too far into that, but if you have all these factors and you have a lower inflation, because part of what causes the rates to increase is also higher inflation. Okay, inflation goes up. Okay, then you do have you do have pressure on the bond market. You do have pressure on the mortgage rates in effect. So when you take all this into consideration and you have the stage set properly, now you can build on those things, and that will cause, just like before, and even in a greater way, the rates that we want to see. What do we want to see? We want to see, rates, the average rate across the country below 5.75 for normal, like for 2 years, 3 years, so that the builders know, okay, all right, we're confident now. We can go out and get more permits, do more building faster, hire on more construction people. The manufacturers can now start doing more product development, producing more product because it doesn't cost as much to do it. So all of this means that we're going to see those changes in the economy for the good, including mortgage rates. Okay. Also, there's the question of, well, how are we going to get more inventory? Well, that alone will get you more inventory. Lower rates means more builder confidence. New inventory really comes from builders, not from resale homes, because usually if someone's selling a home, they're going to be also buying a property. They're not going to go live in a tent, unless they're an investor, but even then, they're going to go out and buy other properties. So, you got about maybe like in the Phoenix area, makes up of maybe about 15 to 20% of our total, you know, um, um, you know, sales and properties with investors. And it's probably like that in most areas in that range anyway. So, a seller is also a buyer, in other words. So, there's that factor. So how do we get prices down? By creating that environment of lower rates, so builders feel more confident to build more faster, bringing down the cost of all the products and lumber and transporting all these goods to make the product to build these properties and all that. Again, because energy prices are lower, regulations are taken out that don't really need to be there, and taxes are lower. Guess what? Hey, now we've got a little bit more room to breathe, and we can over a longer sustained period of time, not 5 minutes, not, oh, rates are lower this week or 2 weeks, and then they go back up again because we have this crazy inverted inflation and year curve yield and all these revised numbers and all this nonsense and these jobs reports and unemployment rates and we missed 1 million jobs that really weren't there, and all these part-time jobs versus real middle income, full salary, maybe even with overtime, with benefits, jobs for most working people in the middle class. Wow, what a concept! Now it doesn't matter so much about, oh, we're getting stuff from over here, but are we really saving anything because we don't have the money to begin with and all that? So all these factors, again, energy, regulation, and yes, taxes will move these things along and stop hindering this. And we need this for a sustained period of time. Now, the one other thing too that Trump did bring up too for his idea is, and a lot of this is would mostly, I got a chart. I'll show it at a different time. I can pull it up. Is and this is mostly going to be for Western states, where this is going to impact Western states, and that is freeing up government lands. Now, a lot of that is in the West for sure. Okay. So that'll impact the Western region more than it will, the east side of the country, eastern side of the country. But that is a thing that will definitely, help take some pressure off anyway. I think it's a great idea. But more so, again, let's just get the cost of doing things down for everyone. Okay. Then, just like before, it stimulates the economy. I don't know why we can't get it through this head. If you take all my money, I have no money. I can't put money into the economy. If you take less of my money, and I choose where I spend it, and maybe there's a sales tax and minor tax here and there, but I can pick and choose where I want to put my money, but I spend more of it, and I've got money to actually spend to begin with. That makes more sense. The economy moves along. You let the market breathe rather than stifling it and being slow and old like this Federal Reserve and this And the other thing too is they're going to have to get oh this is huge, controls on government spending, because inflation is too many dollars chasing too few goods. Too many dollars chasing too few goods. And Yes, unemployment, jobs reports, all that matter. But if your inflation goes sky high, your rates are going to go sky high. Period. End of story. So if you stop the if you have better budgeting in government and you stop printing all this money unnecessarily and sending it to people who, we got our own problems here. We have our own problems here at home, like how much it costs to buy milk, eggs, and bread, okay, and gas. So let's get the baseline going first, guys, and then we can worry about everybody else, right? So when we get those things taken care of, and we stop spending all this money in government, which creates that is printing too much money creates the majority of the inflation, okay, that we're seeing, you know, and then you'll start seeing, and then with the energy costs, that's another huge. Those two things and the regulations. I'm telling you, I'm telling you, as a business owner, this is humongous. Okay. I don't care if you're IBM or me or somebody who's, doing a podcast or somebody who is doing whatever, big or small business or medium sized business, doesn't matter. Okay. If you're an employee, you want these things because then you can get the raises you want. You can get the things you want at your job. Trust me, it's how it works. It's how business works. It's how it's worked. And when you don't have the corruption in the markets and the crony capitalism and too big to fail concepts and things like that, and you let the business, you let the market breathe, you let the market set its own, let the market set the prices. In other words, get the government out of it, okay, and then you'll have what capitalism should be. Okay, so let's look at this 10-year treasury. We look at this because this is the what drives the mortgage rate. Now, we talk about the splits. The split should be normally about 200 points difference between this and the mortgage rates. The average mortgage rate that you see across the country. You can get lower mortgage rates with mortgage brokers. We deal with them. Love to be able to talk to you about that, how we can do that. We also have buy down rates right now, which are super popular, going to be more popular while we're in a buyer's market on resale and new build homes. You can get lower rates now. I've seen them as low as 1.9% starting point. Okay. Let's talk about that. You can get down payment assistance. You can get down payment assistance. You can get all these things. But this right now is at 4.29. Let's just round it off. Okay. 4.2, 4.3, whatever. It should be, in other words, that should be at the most right around 6.2, 6.3. Okay. So let me push this out here. We are today, let me refresh this, make sure I've got we are today at 30-year fixed, 6.9. So 6.9. Okay. So that's still, the splits are still a little high, but they are better than they were, over a year ago. Got a little wonky the last week or two with this crazy ness in the market. People just can't read or listen to or understand history sometimes in the bond market, but we don't want to break that 4.4 mark. Okay. And we haven't. So that's good. Remember we went all the way up to 5. That's when we had those 8% interest rates. Those splits were way off. Five on the treasury, 8% mortgage rates. That's a 3-point swing on the splits. So here's where we are right now. 6.9. We're at 4.29. So say 4.3. So 4.3, 6.9. Okay. Those splits will get better as the economy gets more normalized and pumping. Okay. All right. So, 30-year fixed mortgage rates. This is kind of just the cycle of where we've been. Look at all that. Big ranges there. 28% of houses for sale are newly built, the lowest share in 3 years. Again, why is that? Because, and you can get the best deals on these right now. Okay. But It's because the interest rates have been too high, too long, there's been too much economic uncertainty. Now we see the rally in the stock market. Why? If you Even if you don't like them, you know what's coming. We're getting rid of regulation. We're going to drill, baby, drill. Energy costs are going to go down. We are going to have an economic boom. We're even talking about having so much of energy dominance that we're going to be exporting energy to other countries. Okay. That will make a difference to everyone. When you go to the pump, when you go to buy eggs, you'll like it. You're going to like it. Okay. I'll take a mean tweet for half the cost in energy prices at the pump and when I pay my electric bill. Okay, just saying. And I don't have to spend 30 or $50,000 on a solar system in order to do it. Okay, how about that? Cromford Market Index right now is at 89, and that is 90 to 110 is a balanced range, 100 being totally balanced. Over 110 is a seller's market. Just to give you an idea, we were in the high fours to around 500 during the crazy period 2 or 3 years ago. Under 90 is a buyer's market. We are in a buyer's market, guys. Our supply is 86, which is 14 points under that 100 mark. And our demand is at 76, which is at 24 points lower than where we would want to be on demand to be completely balanced. When these two numbers are the same, we will be at 100, but they are not. Okay. So you can see that now our demand is slow because of prices being driven up. Okay. What solves that? More supply. What solves that? Get the regulations out of the way, get the interest rates down so that builders can build more homes. Where are they going to build them, Chris? On land. Well, the west part of the country is going to get more. Maybe there'll be some other developments in some of the bigger cities and other areas. I mean, even there's a lot of land even on the East Coast out there that could be bought up for properties. Okay, we need supply. We need supply. I showed you we're coming off the historical low levels. I showed you that earlier in the week from 240,000 homes for the whole country one of the weeks. But Chris, are we going to, that was just one of the weeks for the whole country. Normally, we want to be, well over a million. Okay. But keep in mind, when they show you those numbers, a lot of that's just permits, dirt, under construction, not really move-in ready homes right now. We've been running anywhere from 30 to 90,000 a week. But Chris, what about the crash? Well, and during the crash, you had 250 to 400,000 homes for sale coming on the market with all the foreclosures that were happening. Okay. Um, so, and people weren't as equity rich. Right now, people are what was the latest number? Like $290,000 in equity. 40% of homes are owned outright. Um, you know, uh, Guys, I'm going to tell you something else. Gen Z had a huge lion's share in this past vote. I'm going to tell you one of the things that they were voting for was better cost in housing. Besides getting a good paying job when they get out of college or trade school, they want to buy a home. They don't want to live with their parents or have to go back to living with their parents. Guess why they voted for this guy? They want lower cost housing. They want housing that's affordable. They want rates that are affordable. So I think a lot of us get this. Um, Again, it all comes back to supply and demand. You want prices to stabilize. Of course, we want prices to go up. We want to gain equity, right? But we don't want them to go up like they were. Okay, and so much of that's baked in. We've got to get more supply, lower rates, lower regulation on building the homes, and provide the land to do it, provide the permits and the land to do it. Stop the red tape nonsense that goes on in some of these states and local municipalities and these high costs to run a business. Sure, you need some regulations. We want to make sure the house is going to fall down, but there is some stuff out there. I mean, what is it? I don't want to misquote this, but I want to say it was like basically like 30 to 40% of the cost to just build a home. People are like, oh, the builders are, they're greedy. Well, 30 to 40% of building these homes comes down to regulations, guys. All the regulations, you see the public, all the public reports and the things that have to be put in the permitting process, and some of the hoops that some of these local municipalities want people to run through. It's absolutely insane. In California, you got the mansion tax, unrealized. Then just in your investing, you've got the capital gains taxes. You've got the unrealized taxes that they wanted to do. I mean, just this crazy stuff. It's like nobody wants that. Can you just let us alone? Let it. It's like these municipalities are kind of like the Fed. Like, oh no, people are having babies, and then when they want to have babies, they want to buy homes, and then they want to buy things for the homes, and they want to make more money at their jobs. Oh, we can't have that. We may have 3% inflation. It's like, guys, come on, just stop with the nonsense. Um, but this is what people do, right? And that's part of the local economy. Somebody buys a home, they buy things for the home, right? You know, we had this scare a few weeks back where Home Depot and Lowe's were like, "Hey guys, we're having huge drops in what people are coming in to buy for home remodels and stuff." I showed you these charts and these reports before, but they're like, this is not good because they know, like everybody else who tracks this stuff knows, that hey, uh, we're gonna run into a recession if you keep this up. A housing recession, not in the equity, but in the sales. In the sales, we basically been running these lower numbers. In the number of sales, the last couple of years because of this nonsense. Let's see, I had this pulled out. Right now we're on track. Let's see, 4.62 million units. Right now the existing number of homes is 3.84 million. Um, so we're basically kind of like on track like we were for last year. 4 million is kind of the baseline. We want to be over 5 million though. Well, where are those homes coming from? Then yes, you have a lot of people moving here, let's just say from other countries right now, and that's giving another pressure on inflation, not having enough housing. Okay, these people have to live somewhere, right? Um, so why are prices going up? Why is housing prices going up? There's not enough places for these people to go. Okay. And then, it costs so much to do anything. Just the cost to do business with these higher rates, the higher Fed's fund rate, that, we're a borrowing money society, right? So it costs more money to do business when you have to borrow money to build the product, to do product development, to manufacture, to do a startup. It costs more money. They borrow money to start a business. Okay. All right, guys, I can go on and on with that. So hopefully we get it now. We get the supply and demand equilibrium. When we read things come out great because we understand what's going on and we can see these data points. Okay, we have history of all this. You go back to the lowest sales in history. You go back to the history all the way back to 1940s. You see, there was only besides the crash, which I think that still needs to be looked into. What really happened there with some of this stuff back with the Great Crash back 2007 to 2011 there. If you strip that out, you only had one other year with a 1% drop in housing overall across the country, 1% drop in equity. Okay. Every other year across the country, you have equity gains. And in the greater Phoenix area, we have higher than usual. Usually it's about double what the rest of the country is. So, really quick here, we've got Fountain Hills is in the seller's market, Chandler, Scottsdale, Glendale, Cave Creek, Phoenix. Again, nothing crazy. Those are all in seller's markets. Avondale, Mesa, Gilbert, Tempe, those are and Peoria, I'm sorry, um, and Paradise Valley, those are all in balance markets. And then Surprise, Goodyear, Queen Creek, Maricopa City, and Buckeye are all in buyers markets. So that's my report for this week, guys. Hopefully it made sense. Hopefully, if you want more numbers about your property, your community, your zip code, your area, what's going on, days on market, if you want to know what's going on with housing prices in your area and all that, and what we would do to get the property sold or help you purchase a property or both, please reach out. We'd love to be able to help you with that, get you the lowest rates possible, get you the best sales price possible. And, even if you just have general questions about like, hey, I'm not even ready to buy or sell now. I just have questions. I love that. Feel free to reach out, call, text, email. Reach out to us on social media. Please follow us on Mincola Group. Share, follow Mincola Group on YouTube, where you can get the full videos. Check us out on TikTok, AZ Realtor. Um, and I'm on Instagram and Facebook. I like to do a lot of stories for the daily reports on what's going on with the markets or interest rates and tips and tricks or what's current for that day. And then a lot of other posts, of course, Facebook, Instagram that we put out there. So it's usually going to be, under Mincola Group or under my name. You can find me on any of these different platforms. Again, Instagram, Facebook, YouTube, and TikTok are kind of where I do most of that. I think I'll be up in my X game here soon too. But anyways, guys, we'll talk to you soon. Thanks.